Hi, I'm John Persinos, editorial director of Investing Daily, with a special video presentation. With me today is my colleague, Nathan Slaughter, chief investment strategist of Takeover Trader and High Yield Investing. Those two advisories are published by Investing Daily's subsidiary, Street Authority. Greetings, Nathan.
Hi, John. Thanks. Good to be here.
Good to have you. You know, Nathan's a modest guy, so I'll take it upon myself to tell you his background, which is impressive. Nathan's previous experience includes a long tenure at AXA Equitable Advisors, one of the world's largest financial planning firms. He also honed his research skills at Morgan Keegan, where he managed millions of dollars in portfolio assets and performed consultative retirement planning services. Nathan holds NASD Series 6, 7, 63, and 65 certifications, as well as a degree in finance investment management from the Sam M. Walton School of Business. Today, I will question Nathan about ways to, quote, bulletproof your portfolio with high-yield stocks. The stock market rally continues, but it's getting wobbly. Nathan, you're a big proponent of high-yield stocks for growth, income, and safety. First, let's get our definition straight. Generally speaking, a high-yield equity is one whose dividend yield is higher than the yield of a benchmark average, such as the 10-year U.S. Treasury note. Beyond that, though, the classification is relative to the criteria set by any given analyst. As the chief investment strategist of high-yield investing, what are your criteria for picking high-yield stocks?
I think we've all had to re-examine the definition of high yield in recent years. When I first broke into this business back in the late 90s, you could collect a risk-free 6.5% payout on U.S. Treasuries and get 8% on AAA-rated investment-grade corporate bonds. Not anymore. But we've never lowered our criteria.
I assume you often venture beyond the boundaries of the S&P 500. Where do you cast your net for high yields?
That's right. But people don't subscribe to my newsletter to hear about widely held stocks like Walmart. We get off the beaten path and look for yields in obscure corners of the market that don't always get a lot of coverage from Wall Street. I'm talking about closed-end funds, master limited partnerships, real estate trusts, business development companies, preferred stocks, convertible bonds. Higher yields are out there. You just have to find them.
Well, what about looking overseas? American investors, they can be parochial sometimes, which means they miss out on the investment opportunities available beyond our shores. What does the international area offer investors these days?
Yeah, about 80% of the world's publicly traded companies are based overseas, 4 out of 5. So limiting your portfolio to domestic stocks is kind of like shopping at the grocery store and only browsing every fifth aisle. You're missing out on a lot of opportunities. Take banking. 16 of the world's 20 largest banks are headquartered outside the U.S. More importantly, dividend yields are richer in many countries like Australia and the U.K., plus valuations are often more attractive too. And if you're worried about runaway government debt and rising inflation and policies that devalue the dollar, those concerns are less of a threat in many foreign markets. So over time, favorable currency appreciation just might sweeten your returns. That's why we have an entire portfolio dedicated strictly to foreign securities.
Well, what are the major criteria that you apply to a high-yield stock before you consider it a buy? I know your criteria are rigorous. What exactly are they?
Great question. I could probably spend an hour on this subject. But to summarize, we're not a trading service where we buy a stock at 18 and flip it the next day at 19. We look for dependable income-producing securities that can systematically build wealth over time. Now, that starts with a macro top-down approach to identify sectors and industries that have good fundamentals and positive tailwinds. Then I handicap those races to try to pick the best-in-class winners. Obviously, we're going to dig into the financial statements to evaluate operating margins and cash flows, capital expenditures, things like that. But I believe it's the qualitative factors that drive the quantitative. So just like Warren Buffett, I only invest in companies with trustworthy management, durable competitive advantages, and strong returns on capital. Those are the kind of businesses that create long-term value for shareholders. And if there's a positive catalyst to unlock that value quickly, even better.
So, if a stock fails to meet even a single one of your exacting standards, you won't put it into the high-yield investing portfolio, correct?
Well, no company's perfect. I'm usually willing to overlook some minor blemishes. As a contrarian, I'm not afraid to buy quality stocks that other investors have abandoned because of a soft quarterly earnings report or some other temporary issue. That's how you get a dollar's worth of assets for 50 or 60 cents. Of course, that's assuming the business has all the unique traits I'm looking for. Honestly, most don't even make it past the first round. But if they do, then I'm willing to give them some time to right the ship and get back on course. But there's a big difference between a bargain and a value trap. Not all turnaround candidates turn. So we have to make sure any wounds are superficial and can heal. If there's a deeper problem that could pose a serious long-term threat, then it's usually best to cross that candidate off the list and move on.
Stock market valuations are excessively high, and we're probably facing temporary sell-offs this year. Why do high-yield stocks offer solid protection during market downturns?
When selling becomes indiscriminate, investors panic and run for the exits. They dump the good with the bad. But most of the holdings in our portfolio have not only maintained dividends during prior economic slumps, but actually increased them. Money will always find excess risk-adjusted returns, so that income stream helps to set a floor during market corrections. Beyond that, just keep in mind that dividend payers by their nature tend to be resilient, all-weather performers. You don't deliver decades of uninterrupted payments by going into an earnings hibernation whenever the market catches a cold.
Yeah, from a high-yield standpoint, which sectors look the most appealing to you right now, Nathan, and why?
I really like what I see in the shipping sector. Global trade's accelerating, and there just aren't enough containers and ships to move cargo from port to port. So rates have moved sharply higher. And considering the long lead time to build new vessels, this imbalance isn't going away anytime soon. I also think we could be on the cusp of a commodity supercycle as cobalt, copper, zinc, and other critical natural resources are on track for widening supply deficits. Monetary policy and fiscal policy are both tugging in the same bullish direction here.
I see. What are some of the common perils of seeking high-yield equities? What sort of avoidable mistakes have you seen investors make?
Well, one of the biggest is simply following the herd. Selling because others are selling or buying because others are buying. Always pay attention to what the business is doing, not other people around you. Another is just being too narrowly focused on the income statement without paying more attention to the balance sheet. Even profitable companies can run into trouble when liquidity tightens up. They might even be forced to sacrifice their dividend. So evaluate not just debt levels, but also restrictive loan covenants and the timing of any near-term principal maturities. But I think the biggest mistake is just blindly chasing yields at the expense of due diligence. Total return is what matters. A 10% yield doesn't do too much if the shares drop 30%.
Nathan, thanks for your time. It's been a great interview, very informative.
Great, thanks for having me.
Thanks for joining us. Stay safe and stay invested.